Well, it looks like Southwest Airlines is proving the doubters wrong. In a quarter where many expected a loss, the carrier not only posted a surprise profit, but also signaled what its CEO is calling a turning point. Welcome back to the channel, everyone. Today, we're diving deep into Southwest Airlines Q3 2025 earnings. We'll break down the numbers, explain why the stock popped, and most importantly, assess whether this is the start of a genuine turnaround or just a temporary blip. Southwest Airlines Co. LUV is a major American airline renowned for pioneering the low-cost carrier model, making air travel more accessible and affordable. Its core business strategy revolves around operating a single aircraft type, the Boeing 737, to streamline maintenance and training, and utilizing a point-to-point route network instead of a traditional hub-and-spoke system to maximize efficiency and minimize turnaround times. The company distinguishes itself through a strong, fun-loving corporate culture focused on exceptional customer service, which includes customer-friendly policies like 2 free check bags and no change fees. Headquartered in Dallas, Texas, Southwest has consistently maintained profitability for decades by controlling costs while fostering high employee engagement, making it one of the world's largest and most admired low-cost carriers.
Southwest reported record Q3 revenue of $6.95 billion, a 1% increase year over year. But the real story was on the bottom line. Analysts were expecting a loss of 4 cents per share. Instead, Southwest delivered an adjusted profit of 11 cents per share. This positive surprise, driven by better cost control and early signs of their new revenue streams working, sent shares soaring about 7% after the announcement. So how did they do it? It boils down to 3 key factors. First, lower fuel costs. At $2.40 per gallon, jet fuel was down 4.5% from last year, providing immediate relief. Second, improved efficiency. Their non-fuel costs, while still up, rose at a slower pace, showing their cost control measures are starting to bite. And third, and this is the most critical one for the long-term story, the very early stages of their massive business transformation. CEO Bob Jordan didn't mince words. He called this a turning point in what he describes as the most significant transformation in its history. For decades, Southwest was defined by 2 things: low fares and open seating. That second pillar is officially coming down. Starting January 27, 2026, Southwest will introduce assigned seating and extra legroom options. This is a huge cultural shift, and it's all about unlocking new revenue. This premium offering, along with paid seat selection and priority boarding, is designed to significantly boost ancillary income, an area where Southwest has traditionally lagged behind its peers.
Now, let's talk about the future. What's the guidance telling us? Management reaffirmed its full-year EBIT guidance of $600 to $800 million. More importantly, they're sticking with their incredibly ambitious recovery plan, targeting $1.8 billion in EBIT for 2025 and a massive $4.3 billion in 2026. They're expecting a record Q4, fueled by strong holiday and business travel demand. And with a solid war chest of $3 billion in cash plus a $1.5 billion credit line, they have the liquidity to see this transformation through. The bull case is strong. The surprise profit shows execution is improving. The revenue transformation has finally begun, which could be a multi-billion-dollar opportunity. They have a strong balance sheet and are a leader in operational reliability. But, and this is an important but, risks remain. Labor and airport costs are still headwinds. The shift to assigned seating is a brand gamble. Will their loyal customers accept it? And finally, those 2026 EBIT targets are very aggressive. They require everything to go right. In summary, Southwest's Q3 wasn't just about beating low expectations. It was the first concrete evidence that their bold plan to move beyond the low-fare open seating model might actually work. The journey is far from over, but for the first time in a while, the market is starting to believe in the destination.
The consensus on Wall Street for Southwest is crystal clear. Hold. That's right, based on analysis from over a dozen major firms, the overwhelming recommendation is to hold on to the stock if you have it, but there's not a strong push to buy it aggressively right now. Let's look at the numbers. The breakdown tells the story. Only about 0 to 15% of analysts have a buy rating on LUV. A massive 50 to 55% are in the hold camp, and a significant 15 to 30% are outright recommending to sell or strong sell. This mixed bag reflects a market that sees both promise and problems. It's a stock that's essentially seen as fairly valued at its current price around $34, with the average price target sitting right there between $32 and $35. There's just not a lot of expected explosive growth priced in. On the bullish side, there's genuine excitement about Southwest's transformation. The company is finally rolling out big changes that customers have wanted for years, like assigned seating and premium features. This isn't just about comfort, it's a direct play to boost revenue. And it's already working. Southwest reported record third-quarter revenue and strong profitability. Analysts like those at Susquehanna, who recently raised their price target to $35, acknowledge these initiatives are a step in the right direction. They're leveraging that famous loyal customer base to navigate this shift. On the bear side, the concerns are equally serious. Analysts point to persistent labor and cost pressures. Wages are up, airport fees are up, and these are squeezing the company's margins. Add to that intense competition pressuring airfares, and you have a classic squeeze. Costs are rising, but the ability to raise prices is limited. This is the margin compression you hear experts worry about. It's why some firms like Citi maintain a sell rating, believing these headwinds are too strong to ignore. For most investors, the hold recommendation makes perfect sense. If you already own Southwest, it might be worth holding on to see if their transformation can successfully fight off the cost pressures. The company is profitable and has a solid plan, but it's a marathon, not a sprint. What do you think? Is Southwest Airlines back on your radar? Let us know in the comments below.